As the U.S. milk supply continues to tighten, what opportunities and challenges are ahead for Class 3 and Class 4 as domestic demand lowers and exports pick up? And as corn planters are starting to roll across the countryside, how might the early planting predictions impact your feed costs? All this and more on the Uplevel Dairy Podcast monthly market update provided by HighGround Dairy. This is the podcast for dairy farm owners, managers, and advisors who are committed to profitability, sustainability, and excellence. I'm Peggy Coffeen, and it's my mission to bring you the conversations that will uplevel your skill set and your mindset so you can be a top performer in the dairy farming business. And here to join me today to give us an update on the dairy markets is Curtis Bosma. He knows what matters to you because he grew up on a California dairy farm himself before cutting his teeth at the Chicago Board of Trade. And it's his mission to take the stress out of understanding markets and provide you with tools to protect your profitability. This episode is brought to you by HighGround Dairy. HighGround Dairy provides global dairy market intelligence, insurance services, futures and options brokerage, and advisory programs to a diverse range of dairy market participants throughout the supply chain. Information shared in this podcast is for educational purposes and is not a solicitation to buy or sell commodities. Opinions expressed are current opinions as of April 17th at approximately 11 a.m. and only represent the views of the speaker and not those of HighGround Trading unless otherwise expressly noted. Curtis, welcome back to the Uplevel Dairy Podcast.
Yeah, thanks for having me, Peggy.
It's so hard to keep up on everything that's going on in the markets. In fact, there's been a lot of movement lately. But one of the reasons that we have you on the Uplevel Dairy Podcast, Curtis, is because you are in tune with what is going on in that space. That is where you live. That is where you breathe. It's April 17th. It's roughly 11 a.m. Central Time right now. What's been moving? Where are things going? And what have you been seeing in the markets?
Typically, when we're looking at these markets, a good place to start is just milk production. So looking at the U.S. overall, we have data through February of 2024. Overall, U.S. milk production was down 1.3% versus last year. And when we look specifically at kind of why this was, a lot of this has to do with just decrease in milk cows. For February 2024, year over year, we're down 89,000 head in the U.S. milking herd. Now we have to attribute 37,000 of that just to New Mexico. New Mexico obviously has been going through a lot of changes in their kind of local dairy economy. We've seen a number of herd dispersal sales there and dairy facilities that have been listed for sale out there. And that's a growing trend that we've been seeing in that region. But yeah, overall milk production down a little bit. And that's the 8th consecutive month that we've had year over year declines for milk production in the U.S.
Curtis, when you were with us in March for the monthly market update, one of the things that was just starting to emerge and that HighGround was keeping a pretty tight pulse on was the bovine influenza A virus as it was starting to take hold in Texas. And of course, at this point, it's now spread into other areas. And so tie in your perspective when we have this conversation about the supply of milk. Do you foresee an impact? What's the bigger picture of this virus and what you've just shared with us when we look at the U.S. milk production?
Yeah, excellent question. I got to give credit to our team in Chicago that's been grabbing all the available information and putting all the resources together there. We do have sort of a resource center on our website there at highgrounddairy.com for anybody that's interested. When you look at this from a markets perspective, and how is this going to influence milk prices ultimately? There's two ways to look at it. One is the supply side. And when you look at it and you say, okay, there's certain herds that have been impacted. It's across, I believe, 8 states now. When herds are infected by this, we're seeing a pretty significant pullback in milk production. So that would be potentially price supportive if we're going to see less production out of those regions that are having herds that are affected. The other way to look at it is from the demand side. Well, whenever we have a headline risk of one of these stories that happens, there is potential for some negative consumer sentiment to look at this and say, hey, if cows are getting sick, then I don't want to eat products from cows because I don't want to get sick too. Now, I will say that, the USDA, and I give a lot of credit to National Milk and other trade federations and stuff that have done an excellent job with their messaging thus far to make sure that everybody in the industry knows that, hey, these products that we're making, everything's pasteurized, everything's safe. There's no reason that there would be transmission from a cow with a respiratory issue to having cheese from a cow or a cow that's on the same farm potentially be an issue for the end consumer of that product. So two ways to look at it, but ultimately it sounds like the majority of cases where they're seeing a drop off in milk. And from what I've heard, the majority of the culling that's happening as a result has been voluntary culling. It hasn't been a significant pullback in herd sizes or anything. But with how tight heifer inventories are at the moment, any instance where you're having to cull a milk cow that you don't necessarily want to at peak production or anything like that could possibly present some challenges down the line as well.
Well, thank you for providing those insights on the bovine influenza A virus and what you are seeing and hearing within your team and out in the industry.
When we look over at the cheese side of things, and specifically looking at cheese in class 3, there's a couple of interesting things to look at. So when you look at cheese production's been slightly down on a total cheese level year over year. And that's in tune with what we were seeing with milk production down slightly year over year as well. But if you look at what kind of cheese that cheese manufacturers are tending to favor right now with these market conditions, we're seeing a lot less production flowing into the natural American style or cheddar style kind of cheeses and more into some of the other varieties. So that would be somewhat supportive, I think, as prices have been for commodity style cheeses in that 140 to 150 range. There's been more value for manufacturers to make other kinds of cheeses, put them in aging programs, and find more value-added ways to work with those products, which is kind of a natural balancing agent a little bit in the cheese markets to a certain extent. Another thing to watch here is with the international cheese prices. So right now, our U.S. commodity-style cheese is at a pretty significant discount to where the rest of the world is at. So that opens up a bit of an export opportunity. So we have seen over the last 2 months, cheese exports out of the U.S. moving higher here. A lot of that has actually increased incremental volumes going to Mexico. So Mexico is typically a pretty large player for the U.S. when it comes to milk powder or non-fat dry milk, skim milk powder exports. But they've been kind of increasing their cheese purchases as well, as we've been a pretty good value buy at these current price levels. One thing that we want to make sure we're highlighting as well when talking about the class 3 futures market here in particular is if you look at some of the price action that's been going on in that market, we've seen a lot of days where prices have been moving up, moving down, and a lot of this is based off of what we're seeing in the cash market. We have now on a couple occasions gotten to this $1.60 level and kind of been testing breaking out of this $1.40, $1.50 range for our cash cheese prices. And that's caused some upward momentum in the futures markets. And I think a lot of that is the market's well aware of some of these supply issues and what may potentially come if we are to work through some of these inventories and get ourselves in a position where this market starts really building some support. That being said, we've been let down from these levels before. So we've seen prices get up to 160 here in recent months and then kind of slip from those levels as well. And when we look at some of the deferred months in the class 3 kind of futures market, cheese pricing in the 180s versus where we're currently in the cash market in the 160s. And then that translates to futures that are north of $18 a hundredweight. Those are levels that are great. I think if we are to work through some of these things, we could see some upper momentum, but you have to look at it in a sense of where we're currently at with the cash market versus where the rest of that forward curve is. And I think a lot of people, when you look at class 3 futures markets or any futures markets of a storable commodity, you see kind of the nearby month prices that are typically at a lower price level. And you see prices for those same futures contracts that are 3, 4, 5 months out that are at a higher price point. And I think a lot of people translate that in their own heads as saying, hey, these markets are going to be better. The prices are going to improve. But I have to remind people that futures markets are not a forecast. They have a fundamental function. So the cheese, which is a large portion of what represents the underlying value of the class 3 milk formula, it's a storable commodity. And people that are buying it and holding it in warehouses have to pay for financing, insurance, storage costs, anything that is associated with holding on to that inventory. And so because of that cost of carrying that product, that's why we typically see these futures markets have an upward slope, especially when prices are at sort of lower levels like this. We commonly refer to this in the industry as kind of the slope of hope. People look at this and say, hey, markets are going to get better. But in reality, it's just a fundamental function of where markets are at. So whenever we're looking at these markets, we have to remember we're looking at it in the lens of where's the current cash market at, which we've said we've gotten to $1.60, but we've struggled to hold on to some of those price levels at that point. And where's the futures markets at, where we can look at some of the deferred months at $1.80 cheese. Well, unless we get to $1.80 on the cash market in the next 60 to 90 days, we're going to likely see some of those deferred futures kind of take a step lower to kind of correct for that cash versus carry sort of curve thing. A little bit more on the class 4 side of the complex. So I know we were talking earlier about how cheese exports with the export opportunity has been great. And that's been something where, because we've been the lowest price thing, we have seen some increased incremental volumes flowing to Mexico. Well, the issue we've run into with that now is when Mexico imports from the U.S., they're primarily importing skim milk powder or non-fat dry milk, and a lot of that is flowing into cheese production for the domestic market within Mexico. Well, if what we're seeing an increase in cheese exports, what we're seeing as a turn of that, or the negative side of that, is we're seeing a decrease in the non-fat dry milk and skim milk powder exports into Mexico. So looking at some of the data here, we've been down about 20% year over year for our exports into Mexico. And again, that's, it's not necessarily a price issue. We're relatively competitive with other markets, but it's more so of a demand issue there. So that kind of gets us to we're still below 15% of overall U.S. Milk solids being exported, which is another reason why we've kind of seen a little bit of a struggle prices to kind of move upward here a little bit. So not a lot of movement on non-fat dry milk because still production and stocks remain on the lower end of things right now. But yeah, the slip in exports have kind of kept prices stable there. On the flip side, when we look at class 4, the butter market has been pushing to, I guess, even like I would call it counter seasonal highs, where normally we would see this type of action in the late spring, midsummer, where we really start to see a strong push from people getting all their holiday purchases done before that season. But right now we've seen a lot of firmness in that market. And I think a lot of this is driven on what we saw last year. Last year, as many of us know, we got to record high prices around $3.50 a pound for butter at the CME spot market. That's something that I think causes a lot of anxiety. If you were the buyer that had to get stuck with the super high price load last year, you don't want to get caught there again. So when you're looking at prices in the 290s right now, you're kind of just saying, hey, we're going to keep staying on this thing because 290 is still less than 350. Now, fundamentals don't necessarily support that to a super high extent, but we're still going to see a lot of strength there. And that's kind of the reason why we've seen class 4 holding on to a lot of the premium to the class 3 market, which of course influences pooling and pricing and all the other decisions that happen that make up milk checks, particularly in the Western U.S.
Now, Curtis, back in March, you had provided some early planting predictions. And so now here we are in April, and some of those corn planters are starting to roll across the countryside. And so we're getting a little bit more data on that topic. So take a moment, and I want you to tie together the projections and predictions of that crop going in the ground with what it means to the dairy producer. And as of right now, early in the season, what do you think that dairy producers can expect for how those planting predictions and what's going in the ground will impact their feed costs?
It's still very early in our available data for the upcoming crop year. But if we combine the prospective plantings report from last month told us with the Ag Outlook Forum information that we have available to us, we can get a sense of what's going on. So if we look at the corn market, expectations were somewhere in that 91 to 92 million acres of planted corn in the U.S. That was decreased to about 90 million acres here. Last year, we had a little over 94 million acres, so pretty significant pullback in that corn planting expectation. But if you look at what the Ag Outlook Forum for USDA gave us, the yield they're projecting here is a 181.4. That would be an all-time record yield. If you look at the trend over the last 30 years, sure, yeah, that it may be on trend to a certain extent. But with where prices are at now and ending stocks coming out of this last year, we're kind of going into this current crop year with an ending stocks that's projected above 2 billion bushels. It's unlikely that we're going to see a really aggressive kind of yield strategy from a lot of these farmers across the Corn Belt. Margins are razor thin for a lot of these things. So that'll be something to monitor. But even with a modest production expectation, just shy of 15 billion bushels for this upcoming crop year, that still puts us in a scenario to where unless exports pick up significantly, we're going to end up with ending stocks potentially at a higher level at the end of this next crop year. To sum all that up, we're likely to see some continued downward pressure on this corn market, at least for the foreseeable future. That being said, it's only the middle of April. There's still a lot of weather and other things that can happen over the next little bit. And then when you look at how the managed money is positioned in that corn market, they're holding a pretty large short position at the moment. And so if something happens with weather or trade politics or anything like that, that is to cause a bit of an upward shift. If we are to see some short liquidation from that managed money, that could really change kind of how we're looking at this market as well.
So this is tying in, Curtis, your conversation from March about what's going on in those markets with that managed money coming into play as we look into what's expected for crop plantings and predictions, but also tying that back into the bigger picture of how much is it going to cost to purchase those key ingredients that are the core of our dairy rations.
Absolutely. It's been very much top of mind here lately, especially with where we're at in the year. And we're starting to get some of the puzzle pieces for this next crop year for us to kind of see where things are at. But yeah, I still call these my way too early season predictions based off of the available data.
Curtis, you've just given us an update on what supply and demand look like in the dairy markets and milk production. And also when we look at the expected feed costs as we head into the rest of 2024, you do a great job of always posing a big question to dairy producers, something that you hear coming up in your conversations out in the field and something that's on the mind of producers across the country. And so, Curtis, what's the big question weighing on your mind and the minds of dairy producers right now?
So I think something that a lot of producers are always looking into is this endless chase of efficiency. And the question that I always want to tie to that is, are these investments we're making in this increased efficiency translating to consistent profitability? What the dairy industry as a whole has done in terms of increasing efficiency at the farm level over the past couple of decades is absolutely amazing. But I do think when you look at the business side of things, these increased efficiency is often sold as increased profitability. It's an interesting way of looking at it, because ultimately, if every producer that's out there and every farm increases efficiency, it actually means at the end of the day, or fast forward 2-3 years into the market cycle, that there may actually be less profitability. Because if everyone can make more milk with less cows, or make it more efficiently, or make it at a lower cost, which is the goal of any commodity production environment, then that lowers sort of where the pain points are from a price perspective. Whenever we look at commodity markets, and especially commodity market cycles, we always talk about this, element of reversion, where every time that prices get too high, well, then it's unsustainable for the end users to be able to achieve profitability at those super high price levels. So we start to see demand erosion, and then that's where prices kind of start to taper off and move back to the downside. Well, then when prices get too low, it's not profitable for the producers to actually produce that commodity, or produce that product. So then we see a reduction in supply. And it's kind of markets have a way of naturally kind of balancing themselves out and always going towards that mean reversion, or that sort of equilibrium where supply chains are happy. But of course, we know that never stays there long. There's always a lot of constant volatility. I think it's interesting when we're talking about investments in efficiency, is that if we're constantly lowering what it costs to make milk, then it's going to make it more and more difficult for everyone to remain profitable in the industry. And that's where making sure that we have strategic kind of financial things in play, so that when things happen, when that volatility is occurring, that we're able to kind of insulate ourselves and cover ourselves for these things. It's going to be able to be beneficial for the business in the long run. I think a lot of people overlook the power of that compounding returns too. You look at a dairy farming operation in the US and you say, hey, how has this family been able to afford all the new technologies that have come out over the last couple of years? And how have they been able to buy that extra plot of land out there that makes good sense for their farming operation to acquire? Well, you kind of look under the hood of some of these operations. In a lot of cases, they have a really good, solid financial plan of how they're looking at this stuff. When you look at the market cycles we're talking about, a lot of the big swings and the big acquisitions that are made to grow these operations happen when margins maybe aren't at the best levels. So I think there's definitely an element of increased purchasing power when the dairy industry is in a situation where cash flows are super tight. But then somebody with a good proactive financial plan has capital to use when other people don't. And that purchasing power, it really helps kind of grow that consistent and compounding growth effect that can happen in the business. And those are difficult things to quantify, but the concepts are pretty visible when you see it in practice.
So really what you're saying, Curtis, here is, though we are in some times that are going to be challenging, this is also a huge opportunity for those that have the ability to capitalize on their position to make those power moves. There are others out there that are saying, well, if they haven't done it before, they might be more intrigued to look at risk management in a different way than they have before. And are you getting those inquiries on a more regular basis?
Absolutely. I'll use the example of when I first started in the risk management space in the summer of 2014, which, as we know, was a really awesome year for the dairy industry from a margin perspective. You're going out to talk with producers about, hey, here's what's going on in the markets. And at that time, the big thing that we were all looking at was the EU. They were removing their milk production quotas. And so, hey, there's going to be this huge wave of milk coming from Europe. Prices could move lower. But at that time, there was sort of this recency bias with the producers of saying, hey, I just got a $24 milk check. Why would I even consider hedging my milk into the first quarter of 2015 at, $18 or $19 a hundredweight? Well, ultimately, we kind of know what happened now is those milk quotas were lifted. We saw a huge surge in production through Europe, and prices kind of fell apart a little bit. Same thing happened again in 2020. We see a lot of increased activity and attention to these things when things are bad. But the people that are reaping the most rewards from it are the people that are taking action when prices are good. I think Warren Buffett said it the best with be greedy when others are fearful and be fearful when others are greedy.
Well, on that note, Curtis, thank you for providing an April update for our monthly market report here on the Up-Level Dairy podcast. And for those of our listeners that would like to reach out to you with some of their questions or get in touch as they explore what might be options for them when it comes to risk management, or just want to know a little bit more about HighGround and some of the resources you have with your monthly market forecast, where can they find that information?
So you can check us out at highgrounddairy.com. And then in the show notes, we'll also have a link to access our monthly market update. So we send out an update once a month with just kind of a big summary of everything that's going on in the dairy markets. So that's something that we offer for the dairy producers that don't have time to kind of sift through everything. It's a good summary of what's going on.
Excellent. All right. Well, thank you so much, Curtis, for jumping on with us once again for a monthly market update from HighGround Dairy.
Yep. Thank you.
And that's right. You can find all of those links to HighGround Dairy in our show notes. Thank you for joining us, Curtis, and thank you to our sponsor, HighGround Dairy. HighGround Dairy provides global dairy market intelligence, insurance services, futures and options brokerage, and advisory programs to a diverse range of dairy market participants throughout the supply chain. I'm Peggy Coffeen, and thanks for listening to the Up-Level Dairy Podcast.